Right, hello, thank you for watching this video. My name is Adrian Boothie, and in this video we're going to be looking at guaranteed stop losses. Now, we all know what a stop loss is. It's an order that can really be used to help us to limit the loss on a particular trade, but it doesn't always get the price that we want, does it? You may have seen this. Sometimes your broker closing you out at a price that's different than you actually wanted. So, for example, you're in a trade at 100, you had your stop in at 90, but you got closed out at 89 or 88 or something like that. It can be something called slippage, so the distance or the difference between your actual fill and the price that you wanted is something called slippage. It can happen quite a lot, particularly over fast-moving markets. So how can we counter that? Well, it could be a case of not trading over fast-moving markets. That's one way of doing it, of course. And some brokers will also allow you to use something called a guaranteed stop loss. It does often have to be a minimum distance away from the market, so it may need to be that your stop loss has to be a minimum of, I don't know, 50 pips or 100 pips away from the current price when you place the order, and they often will charge for it, which is why, because they're taking it on their own book, it's usually only market makers that will offer a guaranteed stop loss. But they can be attractive, particularly to very new traders, particularly if you're looking to, you're a bit uncertain over the weekend, or you're a bit uncertain over non-farm payroll or something like that. I don't particularly use them. I have to say, in my opinion, I do think that the benefit of them doesn't really outweigh the cost of them over time. But you know what? It's up to you. Everyone has to engage in their own level of risk and risk management. Certainly, some brokers offer them, and they are available if you do want to use them. So let's have a look and give you a little bit of an example. So just very basic here. We've got an entry at 100. We've got our stop loss in at 90. So what's happened is over the next, I don't know, couple of days, couple of minutes, whatever it may be, the price has rallied a bit and then started to come off. Doesn't really matter what's happened, but ultimately we've had a gap. It could have been over the weekend. It could have been over a fast item of data, non-farm payroll, interest rates, something like that. Could have been an equity, and it could have had an announcement, could have had a profits warning. Any number of things can cause a market to gap in this fashion. Might simply be a stock that closes overnight and then reopens. Ultimately, you can only get filled on your order if there's somebody there who wants to buy or sell to you. In which case, if you're long a particular market, you bought a particular market at 100, you then have an order to close there at 90. That's our normal stop loss order at 90. Okay, so that means if you long or you bought $1 at 100 and you're looking to sell it at 90, if you're trying to sell something, somebody's got to want to buy it at that price, haven't they? Okay, you've got to be matched with someone on the other side of the transaction. If you want to buy something, someone's got to sell it to you. It's basic, very simple economics, I suppose. The thing is, though, what you'll notice is that big gap there. You'll notice as the price suddenly stopped and jumped down from there to there, opening, let's say, the next day or the next minute down at 80. What does that mean? It means that the price has just dropped. So you're trying to sell at 90. Problem is, nobody wants to buy it at 90. In which case, if you're trying to sell and a stop order is a market order, you're trying to sell at the first available buyer. That's what you want. You're chasing the market to get you the hell out of that trade. And what that means is that you are prone to slippage on market orders. And that's, as I say, what stop losses are. You're looking for that first available buyer after your stop loss has been triggered, which is going to be down towards that 80 area, because that is the first guy that wants to buy it down at that 80 level. So how can we protect ourselves from this? Yes, we're going to get slippage. So what can we do? We could use a broker that offers a guaranteed stop loss. We'll have to pay for that privilege. It might cost 3 or 5 pips, something like that. And not every broker will offer it, but it does give a little bit of peace of mind, particularly if you're quite new to trading or if you like to trade over major results or major events, basically. But effectively, what it will do is it will mean you'll place a guaranteed stop loss order at 90 pence. So regardless of what happens or how fast the market goes through, your market maker broker will fill you at 90 if 90 is traded. See what I mean? So it doesn't really matter what happens and how much it gaps below this, you're going to get filled at 90. Sounds attractive, doesn't it? But you've got to pay for that privilege, okay? You've got to pay a transaction fee for the benefit of a guaranteed stop loss, and not every single broker will offer it. But there is a use for it if you're quite a risk-averse trader or if you're trading in a particular style.